The deal that quietly powered the American empire for half a century just ended, without a single headline screaming its name. Subscribe now, because what you're about to hear explains why your money may never feel safe again. For most people, oil is just fuel, and the dollar is just paper. But for 50 years, those two things were welded together in a secret financial marriage that reshaped nations, wars, inflation, and power itself. And in 2024, Saudi Arabia walked away from it. No ceremony, no apology, just silence. Yet the consequences will echo through every paycheck, every mortgage, and every savings account on Earth. The story doesn't begin in 2024. It begins in the ashes of collapse. In 1971, the US dollar quietly died as real money. The gold backing was cut loose. The world's reserve currency became paper-backed only by confidence. At first, the collapse should have been fatal. Without gold, the dollar should have flooded the world, lost trust, and collapsed under its own weight. But instead, something extraordinary happened. A replacement for gold was engineered. Not metal, not minerals, energy. Oil became the new anchor. 2 years later, American officials flew into the desert and locked doors with Saudi royalty. What emerged from those rooms was never voted on by any parliament. It was never announced with a treaty. Yet it became one of the most powerful financial structures in history. Saudi Arabia agreed to sell oil only in US dollars. In exchange, America guaranteed military protection and access to global capital. Every country that needed oil now needed dollars first. And just like that, the dollar found its new gold. From that moment forward, global trade, shipping lanes, military bases, debt markets, and inflation all bent around a single axis. If you wanted energy, you funded America. If you wanted to grow, you stocked US debt. The Federal Reserve could print without the normal consequence of collapse, because every printed dollar was soaked up by the world's hunger for oil. It didn't feel like domination. It felt like normal life. Gas stations appeared everywhere. Suburbs expanded. Credit became effortless. Imports flooded ports. Inflation stayed strangely obedient for decades. America consumed more than it produced and paid with paper. The world accepted it, not out of kindness, but necessity. But necessity always has a breaking point. By the 2000s, cracks started forming quietly. Countries that had built mountains of dollar reserves began to ask a forbidden question. Why are we saving another nation's currency while our own economies struggle? Then came 2008. Then came endless quantitative easing. Then came pandemic money creation on a scale never attempted in human history. Trillions appeared from nowhere. The old petrodollar system absorbed it all for a while. But something changed in the balance of fear. America began to use the dollar not just as money, but as a weapon. Sanctions froze entire national reserves with the click of a keyboard. Trade routes were strangled without ships. Nations discovered that holding dollars no longer meant safety. It meant vulnerability. Gold reserves started moving east. Bilateral trade agreements bypassed the dollar silently. Digital settlement systems emerged outside Washington's reach. And Saudi Arabia, once the immovable pillar of the dollar system, started signing contracts in yuan. At first, the world dismissed it as symbolic. Then came 2024. Without press conferences or formal announcements, Saudi Arabia simply allowed the petrodollar agreement to expire. Oil sales and currencies other than the US dollar became official. The spell that began in the 1970s was broken with a whisper. And here's the unsettling part. Most people didn't even notice. But global markets noticed instantly. What looks like a technical shift in invoicing is actually the slow collapse of a financial gravity field. The dollar no longer has an automatic claim on the world's most critical commodity. Demand for dollars is no longer guaranteed by energy itself. And when demand for a currency becomes optional, everything about its price, its inflation, and its debt changes. The system that allowed America to borrow endlessly at low cost has begun to lose its oxygen. This is where the danger hides. Because when a reserve currency weakens, governments don't collapse first. Prices do. Savings do. The middle class does. The invisible tax of inflation becomes visible only after it's already done the damage. The printing press doesn't stop. It accelerates, desperately trying to fill the vacuum left behind. What comes next is never announced in advance. Only later do historians give it a name. The end of the petrodollar is not a headline. It is a slow-motion economic unmasking. a revelation that the world was running on a carefully maintained illusion of endless demand. And now that illusion is slipping. Currencies don't fall in one clean moment. They fracture first, in trade agreements, in swap lines, in energy contracts, in investor confidence, in psychology. And psychology is always the real battlefield. Because once enough players believe the structure has changed, it has. The dollar is still dominant, for now. But it no longer stands unchallenged on top of oil. And without oil beneath it, the weight of American debt becomes something the world must finally feel rather than ignore. This is not the collapse of the United States. This is the collapse of a financial privilege that lasted half a century. And history has never been gentle when privileges expire. The deal was never written in headlines. It lived in quiet handshakes, in vaults and pipelines, in oil contracts stamped in ink that never dried in public. In the aftermath of the 1970s oil shock, when lines snaked around gas stations and the world learned what energy scarcity felt like, Washington and Riyadh locked themselves into a bond that would quietly rewire the global economy. Saudi Arabia would price its oil only in U.S. dollars. In return, the United States would guarantee the kingdom's security, flood it with weapons, protect its shipping lanes, and quietly ensure the House of Saud would never stand alone. From that moment on, oil and the dollar became inseparable twins. Every nation that needed energy, which meant every nation that wanted to function, first had to obtain dollars. Not gold, not silver, not their own currencies. Dollars. The green paper became the blood type of the modern world. This wasn't just trade. It was architecture. It forced every central bank to hold dollars in reserve. It forced developing nations to borrow in dollars. It forced global banks to settle in dollars. And it allowed the U.S. to run deficits no empire in history could have survived without collapse, because the world itself was trapped inside America's balance sheet. As decades passed, the machine grew more sophisticated. Oil revenues recycled into U.S. Treasury bonds. Treasuries funded deficits. Deficits funded spending. Spending strengthened global demand. And global demand strengthened the dollar again. A closed loop of power so elegant it felt invisible. Wars came and went. Presidents rose and fell. Markets crashed and recovered. Through it all, the petrodollar kept humming quietly in the background, stabilizing chaos, absorbing shocks, masking the true cost of American debt. Inflation could be exported. Pain could be deferred. The bill could always be rolled forward into the future. For Saudi Arabia, the system brought protection and wealth beyond imagination. Petrodollars transformed a desert kingdom into a sovereign investment empire. The skyline of Riyadh rose from sand. Megacities bloomed where camels once crossed. Wealth pooled into sovereign funds measured not in millions, but in trillions. Yet beneath the surface, dependency hardened on both sides. The U.S. became addicted to external demand for its currency. Saudi Arabia became dependent on American military umbrellas. Neither side could easily walk away without consequences no one fully understood. But history never freezes. It only pauses. By the late 2000s, the cracks began to show. The global financial crisis exposed just how leveraged and fragile the dollar-centered system had become. Trillions were conjured with a keystroke to rescue banks. Balance sheets expanded beyond any historical precedent. Quantitative easing became the new normal. And for the first time, foreign nations began to openly ask an uncomfortable question. If dollars could be created infinitely, what exactly backed their value anymore? China watched carefully. Russia took notes. The Gulf listened. Trade deals began to change shape. Bilateral settlements in local currencies appeared quietly. Energy contracts were whispered in euros, yuan, rubles. Gold reserves quietly grew in central bank vaults across Eurasia. Payment systems outside the SWIFT network began to sprout like underground tunnels beneath the global financial city. Still, the petrodollar stood. Not because no one challenged it, but because no one had yet moved first. Then came the new century's other shock: sanctions. When Russia was cut off from dollar clearing, when reserves were frozen overnight by decree, when global finance revealed itself as not merely neutral pipes, but geopolitical weapons, something fundamental shifted in the psychology of power. Holding dollars was no longer just an asset. It was also exposure. It meant trusting that Washington's political winds would never turn against you. For energy exporters, That realization cut deep. Saudi Arabia had watched decades of monetary alchemy turn the dollar from gold-backed certainty into pure paper confidence. It had watched debt soar past 30 trillion. It had watched inflation rage after pandemic stimulus. It had watched central banks lose control of narratives they once governed quietly. And slowly, almost invisibly at first, the kingdom began to reorient. New trade corridors opened eastward. Energy deals were signed in local currencies. The yuan entered contracts once sealed exclusively in dollars. Rupees followed. Digital settlement rails were tested. BRICS discussions intensified. Oil was still flowing, but the currency it flowed through began to change tone. By the time the world noticed, the shift had already matured. In 2024, the unthinkable was made official. The 50-year petrodollar arrangement quietly expired without renewal. No dramatic speech. No emergency summit. No sudden collapse screen captured on trading terminals. Just silence where a pillar once stood. What vanished in that moment wasn't a clause in a treaty. It was a psychological anchor that had held the modern financial system in place since Nixon closed the gold window. For the first time in half a century, the world's most important commodity was no longer contractually bound to the U.S. dollar. Oil had been liberated from its monetary cage. And suddenly, the dollar was exposed to the same gravity every other currency had always faced. Demand was no longer automatic. For global markets, this was not a headline. It was a tremor, quiet, deep, structural, the kind of shift that does not crash screens in one day, but rearranges history over a decade. Because the petrodollar had never been about Saudi Arabia alone. It was the demand engine behind trillions in U.S. treasuries. It was the silent buyer that absorbed deficits without rebellion. It was the hidden stabilizer that allowed America to live beyond its means without immediate collapse. And now, the engine had lost exclusivity. The question no one wanted to ask out loud suddenly mattered. What happens when the world no longer needs dollars to buy energy? For decades, inflation had been exported. Excess liquidity had flowed outward through trade deficits. But when the procession reverses, when dollars no longer lubricate global commerce automatically, they do not vanish. They come home. And when a reserve currency comes home, it doesn't arrive quietly. It arrives as price pressure, as higher yields, as collapsing purchasing power, as political panic framed as monetary policy. Markets began to sense it before politicians did. Treasury auctions required higher yields. Foreign participation wavered. Gold surged quietly. Central banks bought metal, not promises. Currency blocks formed regional gravity wells. None of this looked like a crisis. That's what made it dangerous. It looked like adjustment, normalization, just another cycle. But underneath the language of markets, the foundation was cracking. The dollar's unique privilege, the ability to finance empire through global dependency, was eroding not through attack, but through diversification. 1,000 small trades had done what wars never could. And now the system stood at a strange crossroads, not collapsing, not stable, but detaching, like tectonic plates that shift silently for years before the quake is felt on the surface. The world hadn't abandoned the dollar. It had simply stopped being owned by it. And for the first time since the 1970s, American power faced a limit that could not be legislated, sanctioned, or deployed against. It was being priced out by history itself. You can already see the outlines of what comes next in strange places. In the rise of regional settlement systems. In energy contracts denominated in baskets of currencies. In gold-backed digital trade rails. In sovereign debt markets where buyers demand real yield again. This isn't rebellion. It's insurance. Nations are hedging quietly against a future where the dollar is no longer the sole gatekeeper of energy, credit, and survival. And survival, in the end, is why the petrodollar existed at all. Because currencies aren't just numbers. They're trust contracts enforced by power. And like all power structures, they last not until they fail, but until they are no longer needed. The world didn't end the petrodollar in one loud decision. It simply outgrew it. And the silence that followed was louder than any declaration ever could be. The deal itself was never printed in bold letters for the public to see. It wasn't announced on primetime television with fireworks or speeches. It lived in back rooms, in quiet memorandums, in the unspoken rules of global power. In the early 1970s, as America staggered under the weight of war, inflation, and a collapsing gold standard, a different kind of lifeline was quietly engineered. Not gold this time. Oil. Black liquid power. Energy as currency. The petrodollar wasn't born out of ideology. It was born out of desperation. In 1971, the United States broke its final promise to the world when it closed the gold window. Dollars could no longer be exchanged for gold. Overnight, money became faith. And faith is fragile. Foreign governments began to question the value of the green paper flooding their vaults. Confidence in the dollar cracked. And when confidence cracks, empires bleed. So Washington looked for a new anchor. Something the world could not function without. Something every nation needed every day just to breathe, to produce, to survive. Oil was that anchor. And Saudi Arabia was the key. At the time, the kingdom was sitting on oceans of crude beneath its desert sands. Black rivers under a sun-bleached land. Energy that powered cities, factories, aircraft, global trade itself. America offered protection, weapons, political backing, and security guarantees in exchange for a single, quiet rule. Oil would be sold only in U.S. dollars. No exceptions. Saudi Arabia agreed. And soon, through OPEC, much of the world followed. From that moment on, every nation that needed oil had to first obtain dollars. To get dollars, they had to export to the United States, borrow from American banks, or hold U.S. Treasury bonds. The entire global energy system became a demand engine for American debt. The dollar was no longer just a currency. It was the bloodstream of the global economy. And the magic trick worked. Every barrel of oil traded became silent support for U.S. borrowing. America could print, spend, and run deficits without facing the same limits as any other nation. While others saved, America consumed. While others balanced, America expanded. And because the world needed oil and oil demanded dollars, the world absorbed America's debt as if it were oxygen. The petrodollar didn't just fund highways and skyscrapers. It funded wars. It funded Wall Street. It funded stock booms, housing bubbles, tech revolutions. It funded an entire lifestyle built on borrowed confidence. But like all financial miracles, it came with a shadow. Over the decades, America printed more and more. Debt became policy. Cheap money became a political drug. Each crisis was treated with larger doses. The 80s, the dot-com bubble, the housing collapse, the financial meltdown of 2008, the pandemic stimulus. Trillions upon trillions created with digital keystrokes. And because the petrodollar kept foreign demand for dollars artificially high, the consequences were delayed. Hidden. Exported. Inflation stayed muted for years. Asset prices exploded instead. Stocks, real estate, luxury goods, financial instruments detached from wages and reality. The rich floated on rising asset oceans. The rest drifted behind, pushed by invisible tides they could not see. And quietly, a different revolution was brewing. China rose. Russia resurfaced. Regional trade blocs began to test the edges of dollar dependence. Sanctions turned the dollar into a weapon. Payment systems became geopolitical battlegrounds. Nations began asking uncomfortable questions in private. What happens when the currency that powers your economy can be frozen, seized, or turned against you overnight? For Saudi Arabia, those questions became existential. The kingdom watched as assets were frozen, reserves seized, economies weaponized through financial infrastructure controlled by Washington. It watched as China became its largest oil customer. It watched as multipolar trade replaced unipolar dominance. And slowly, something shifted. Deals began appearing outside the dollar. Small at first. Test runs. Infrastructure loans settled in yuan. Energy contracts priced in alternative currencies. Digital settlement layers built quietly underneath the old system. And in 2024, the sentence that had lived in the background for 50 years finally expired. No announcement. No ceremony. Just confirmation that the exclusive dollar-only oil settlement framework was no longer binding. The petrodollar, not abolished, but no longer absolute. Not dead in a dramatic explosion. Unplugged. And what followed was not panic. It was something far more dangerous. Silence. Markets didn't collapse overnight. Oil didn't stop flowing. Gas stations didn't go dark. But under the surface, the circuitry of global finance reoriented. Trade corridors adjusted. Settlement layers diversified. Dollar demand began to fragment. not crash. A slow financial erosion rather than a sudden implosion. For America, this moment is not about losing dominance tomorrow. It's about losing the unfair advantage over time. Without enforced dollar oil demand, debt becomes heavier, printing becomes louder, inflation faces fewer buffers, treasury buyers require higher incentives, interest rates become political explosives, fiscal discipline stops being optional and starts becoming survival. And for the rest of the world, the illusion of dollar safety begins to thin. Central banks diversify quietly. Gold repatriation accelerates. Bilateral trade bypasses dollar clearing. Digital settlement technologies multiply like fractures in old plumbing. This is not the end of the dollar. It is the end of a guarantee. And when guarantees vanish, psychology changes faster than any policy ever could. The moment the headlines finally caught up, it was already too late. No emergency press conference. No red ticker on Wall Street. Just quiet confirmations buried in trade reports and bilateral agreements. Saudi oil sold in yuan, then in rupees, then in currencies that never passed through New York at all. The market barely flinched at first, and that should have been the warning, because the most dangerous shifts in finance never arrive with sirens. It bled out silently, deal by deal, shipment by shipment, handshake by handshake. For half a century, the world's energy ran through one pipe, the U.S. dollar. Every barrel of oil created instant global demand for American debt. Every dollar printed could be absorbed by foreign reserves desperate for fuel security. It was the purest form of financial alchemy ever created. And now that loop is breaking, not with protest, but with alternatives. Trade corridors forming without Washington's permission. Energy contracts settling outside the dollar's orbit. Central banks no longer recycling surpluses into treasury bonds, but into gold, regional currencies, and quiet bilateral credit lines. Here is the part almost no one wants to say out loud. The petrodollar didn't just support American power, it disguised its cost. It hid the true weight of deficits. It softened every recession. Without that system, America's debt becomes fully visible. Every dollar created now competes in a world where others no longer need to hold it. And when demand weakens for the world's reserve currency, everything priced in that currency rewrites itself. Wages, housing, stocks, food, energy, and the invisible tax called inflation. The twist isn't that Saudi Arabia turned away from the dollar. The twist is that it could only do so because the world is already building something parallel underneath the old system. China didn't just offer the yuan, it offered liquidity. India didn't just offer rupees, it offered growth. Energy exporters aren't abandoning America out of rebellion. They're hedging against a future where one currency no longer anchors everything. This isn't betrayal, it's insurance. And when insurance spreads, psychology changes. Investors stop assuming treasuries are the ultimate refuge. Central banks stop behaving as passive vaults for U.S. debt. Nations begin trading directly instead of routing value through one financial capital. The dollar doesn't vanish, it absorbs competition. And competition is the one force reserve currencies were never designed to survive. The ripple doesn't stop at currencies. It flows into military strategy, supply chains, sanctions power, and diplomatic leverage. The petrodollar was never just about oil. It was about whose rules governed global settlement. As energy slips into multi-currency trade, sanctions weaken, borrowing costs rise, and alliances grow transactional instead of automatic. The center of gravity starts to move, not suddenly, but permanently. And here is the most uncomfortable truth of all. This shift doesn't require a crash to change your life. It works through slow pressure, through the quiet erosion of purchasing power, through longer cycles of tightening, through governments forced to choose between social stability and fiscal discipline. The end of the petrodollar doesn't look like collapse. It looks like years of adjustment no one voted for. History is filled with moments when empires didn't fall from invasion. They dissolved through accounting, through confidence leaking away, through parallel systems growing strong enough to make the old one optional. And the most dangerous phase is always the middle, when everything still seems functional on the surface while the foundation is being replaced underneath. The question is no longer whether the petrodollar era is ending. The question is how the world behaves while it does, and whether we recognize the transition for what it is, not a headline event, but a financial season that rewrites power one transaction at a time. If you want to understand the money before it understands you, stay with this channel.